exposure, that went, ironically being a hedge fund, that went unhedged. But when it came to companies that we owned 100% of, there we're going to be a lot more careful, right? So now we're Qantas, right, and we're responsible for managing that currency risk. So, at that point, we're going to work with management and make sure that they're managing currency appropriately. On the hedge fund side, we're going to manage kind of the balance sheet piece of that as you described it, right? So, to the extent like we, own securities that are in a different currency, and there's just some currency risk associated with that, we're going to hedge that out, as close to 100% as we can. And, and I guess, this comes back to your original point. So, so when you decide, do we use a proxy hedge there? And again, I think it depends on the market. So we had a power investment, with several power investments in Europe. Well, these are kind of bad examples because again, so here it was euro risk, and it's kind of like no question you're going to go straight to just the USD euro hedge, which is just easy, highly liquid. There's kind of no real good substitute for it. But to the extent you own an investment in Australia and you're looking at potentially paying a pretty steep price for so some of these plants, for example, I'm not that familiar with the Australian power market, but in the U.S. And in Japan and in Europe, you very frequently have what are known as like tolled power assets, and so these will be assets that they're essentially contracted out for anywhere between a couple of years up to you might see 15, 20-year power contracts. So when you have contracts like that, I would suspect, and again, not knowing the Australian, not knowing what hedges like that might look in Australia, but I would assume that based on the fact that bid-ask spreads on Aussie dollar tend to get pretty large once you start to move out even past a month. You might just start to see really steep bid-ask hedges and bid-ask spreads, and so at that point you may look to proxy hedge in an alternate currency.
Can I just drill down on that a little bit in terms of the volatility between the Canadian dollar and the Aussie dollar? Because being a hedge fund, you would know that the actual fact they do trade the AUD CAD pair a fair bit. Traders make money out of trading those currencies, right? So obviously they can't be perfectly aligned, otherwise you wouldn't make any money. It'd just be a flat line. And so there must be a fair bit of volatility where there is when you look. When you're talking about the further out you go, the bigger the spread is between the Aussie dollar. Is that because of the recognition that there isn't that correlation? I would have thought that would have been a recognition there isn't that correlation as much with the AUD and the CAD as one would think, and therefore you have a greater risk as you're going out. Hence, the greater spread starts to cut into the AUD forwards, etc. Would that be a fair assumption or not?
That's an interesting hypothesis. I don't know the answer to that. That's an interesting hypothesis. Yeah, I don't know the answer to that. I think I really don't know. I don't know. Again, on that, I think you'd want to. I'd love to go ask. Again, I kind of know two guys who would be able to answer that question better than I could. It's possible.
As in your experience, as a hedging instrument, what instrument would you normally? Once again, it's a bit hard because your experience with hedge funds. But as a hedging instrument, do you use forwards as opposed to say something like a cost of collar type option product for hedging? Say, for instance, a capital amount or whatever it is. Like your capital balance sheet, etc. What would be the appropriate derivative you would use?
I think forwards are readily tradable. Commonly forwards were very, very common.